Introduction to Corporate Finance. The term finance is related to money and money management. Success of any business organization depends upon the efficiency with which it is able to generate and use funds. Henry Ford rightly states, money is an arm or leg. Use it or lose it. This statement clearly brings out the significance of finance for the success of a business. Finance is related to money and money management. Financial management mainly concerns with raising of finance and effectively using it for achievement of goals of the organization. According to Henry Ford, money is an arm or leg. Use it or lose it. This statement clearly says that finance is very important for success of any business. Definition. Henry Howland expressed the view that corporate finance deals primarily with the acquisition and use of capital by business corporations. The finance manager of any corporation has to ensure that the firm has adequate finance, they are using the right source of funds that have minimum cost, the firm utilizes this fund effectively, they are generating maximum returns for its owners. The following two decisions are the basis of corporate finance. Point 1. Financing decision. The business firm has access to capital market to fulfill its financial needs. The firm has multiple choices of sources of financing. The firm can choose whether it wants to raise equity capital or debt capital. Firm can even opt for bank loan, public deposit, debentures, etc. to raise funds. The finance manager ensures that the firm is well capitalized, that is, they have right amount of capital and that the firm has right combination of debt and equity. Financing decision. The financing decision involves two sources from where the funds can be raised. Using the company's own money such as share capital, retained earnings or borrowing funds from outside in the form of debenture, loan, bonds, etc. The objective of financial decision is to maintain an optimum capital structure, that is a proper mix of debt and equity to ensure the trade-off between the risk and return to the shareholder. Point 2. Investment decision. Once the business firm has gained access to capital, the finance manager has to take decision regarding to use of the funds in systematic manner so that it will bring maximum return for its owners. For this, the firm has to take into consideration the cost of capital. Once they know the cost of capital, firm can deploy or use the funds in such a way that return are more than cost of capital. Investment decision. A financial decision which is concerned with how the firm's funds are invested in different assets is known as investment decision. Investment decision can be long-term or short-term. A long-term investment decision is called capital budgeting decision, which involve huge amount of long-term investment and are irreversible except at a huge cost. Short-term investment decision called working capital decision, which affect day-to-day working of a business. It includes the decision about the levels of cash, inventory and receivables.